A recession can feel like a trap for your money, but there is a simple, repeatable plan you can follow to protect and grow wealth when prices fall. Here's the plan you can actually run this month. First, get honest about money today, your essential expenses, any debts, and what you can realistically save each month. This clarity makes the plan possible. Step 1 is the emergency fund. Aim for 6 to 12 months of essential expenses in a liquid account you can access quickly. Next, look at debt. If you carry high-interest debt, focus on paying it down before heavy investing. A clean slate here makes investing more durable. Now the two buckets. Two buckets keep your plan simple and guard you against fear. The safety bucket should hold roughly 40% of your investable money. Put it in high-quality bonds, cash, and short-term money market funds. The goal is capital preservation and liquidity. The growth bucket gets roughly 60% of your investable money. Invest in broad, low-cost stock funds and a small tilt toward high-quality dividend stocks. Why this split? The safety bucket avoids big losses when the market falls, and the growth bucket makes use of growth when the economy improves. Automatic contributions start here. Make monthly automatic contributions to the growth bucket. Let time in the market do the work, not trying to pick bottoms. Rebalancing matters. Rebalance at least twice a year to keep the 40-60 split. If one bucket drifts by more than 5 to 10 percentage points, adjust back. Quality and risk matter. Focus on quality, avoid hype, and look for sustainable cash flow and manageable debt. During a recession, sectors matter. Some sectors hold up better during recessions. Utilities, healthcare, and consumer staples often show steadier demand. Costs and taxes matter too. Choose low-fee funds to keep costs down. Use tax-advantaged accounts when possible and be mindful of tax implications. Emergency fund specifics. High-yield savings accounts offer some return and liquidity, while money market funds can be a landing spot during volatility. Hands-on example with $50,000. You have $50,000 to invest right now. The safety bucket is 40% or $20,000. Split that into $12,000 in high-quality bonds and $8,000 in cash or cash equivalents. Growth bucket for $50K. The growth bucket is 60% or $30,000. Put $24,000 in a broad market stock fund and $6,000 in a dividend-focused fund. If you prefer index funds only, you can place $30,000 into a total stock market fund and keep $20,000 in the safety bucket. Adjust the numbers to your situation, but keep the idea intact. Safety first, growth steadily, and time as your ally. What if you have less money? The math scales down. With $15,000, aim for 40% in safety, $6,000, and 60% in growth, $9,000. Break those $9,000 into a broad stock fund and a smaller dividend tilt. The plan still works as a habit, not a one-time event. Age and goals change the mix. If you're closer to retirement, you might want a bigger safety bucket or more bonds. If you're young, you can tilt a bit more toward growth, but keep the plan disciplined. Common mistakes to avoid. Don't chase hot stocks in a downturn. Don't skip the emergency fund, because fear breaks plans. Don't put everything in one asset or try to time the market. Build the habit side. Track your net worth every month, not just the numbers in your wallet. Set automatic reminders to review your plan twice a year, and keep a simple log of what you bought and why. When markets fall, your plan should still feel calm. The safety bucket protects you from big losses, and the growth bucket gives you exposure to the rebound. You're not guessing the bottom. You're building wealth with steady steps. Long-term perspective matters. Markets rise and fall, but a steady, simple plan tends to grow wealth over time. Recession or not, the math stays the same if you stay committed. The plan is practical, repeatable, and adaptable. It works whether you're just starting out or you've saved a bit already. Like this video if you found it helpful, subscribe for more practical money moves, and leave a comment with which part you'll start with.